Hi there! Thanks for viewing this video. Today we're going to talk about financial statement analysis. Let's talk about first the concept of the topic. We know that the accounting is not only about the preparation of financial statements, right? It also includes interpreting the financial statements. It means we need to convert the account and its balances into words or information about the company, otherwise those FS account balances are useless. That is why we have this topic. So how do we exactly extract information? The answer to that is in the topics covered in this video lecture series, and those are the horizontal analysis, vertical analysis, and ratio analysis. Let's have first the horizontal analysis. So we have, it's just comparing the account balance of the company from different time periods. So what do I mean? So if you have sales of 1 million in year 1 and sales in year 2 of 2 million, then you can say that there is a change of positive 1 million. If you wanted to get the percentage change, you can say that there is 100% increase in sales. How did we get the 100%? Of course, by using a certain fraction in which the numerator is the change in amounts. In this particular example, we have the change in amounts of 1 million, so we're going to use that. And of course, we have the denominator, the amounts in the base year. And the base year is usually the amounts in the past year or the past period. So we have sales in year 1 of 1 million, so we're going to use that. And you got 100%. You can also do this with other accounts like expenses and others. By doing this, you can extract necessary information. Like in this example, we can say that the company did well because the sales increased. But if you wanted to know more about this increase, you can investigate what's the specific reason or reasons why it increased by 100%. And that's it for horizontal analysis, or what do we call sometimes the trend analysis. Next is we have vertical analysis. So unlike horizontal analysis, the vertical analysis compares the account balance to either the total assets of the company or total revenues of the company, depending on the nature of the account. That means if it is a balance sheet item like cash, receivables, payables, inventory, or equity, then we compare it with the total assets. But if the account is an income statement account, then we compare it with the total revenues. Let's have an example. So your net profit is 200,000 and the sales is 2 million. Of course, you're going to compare the net profit with sales, not with assets, because net profit is found on the income statement. So when you compare those amounts, then you can say that the net profit is 10% based on sales. But if you wanted to sound intelligent, you can say that the net profit margin is 10%. Sometimes, the net profit margin is also called as the net profit ratio, and sometimes it is called return on sales. So aside from knowing that the net income is 10% of sales, you can also deduce that the cost and expenses is 90% based on sales. Or if you wanted to sound intelligent again, you can say that the cost and expenses ratio is 90%. But before we go to the concept of ratio analysis, I want to tell you that you can be creative in both vertical and horizontal analysis. For example, you're a member of a certain industry, like for example, fast food industry, and the overall net profit ratio of the fast food companies is, for example, 12%. You can compare your net profit percentage with the net profit percentage of your industry as a whole. So if you have 10%, just like in this example, then you might want to investigate why, because there might be something wrong. By the way, if you compare your amounts or percentages with the industry amounts or percentages, you're actually doing a trend analysis. So that's it. Let's go now to the longest topic under financial statement analysis, which is the ratio analysis. So in this topic, you will encounter a lot of formulas that can easily be forgotten. So our technique here is to understand the meaning of the formulas and what's the concept behind, and how to interpret the answers to those formulas so that we will never ever forget those. So actually, there are 4 sets of ratios that I'm going to discuss with you. We have the liquidity ratios to know if your company is liquid. The company is liquid if it is able to settle its currently maturing obligations or obligations within 1 year. The second set is solvency ratios to know if the company is solvent. The company is solvent if it can settle its long-term obligations. Simply stated, we are going to ask if the company can return the funds borrowed from long-term sources like loans from banks and investment by the owners. We can also have the profitability ratios to know the level of profitability of the company. And lastly, we have the market ratios that might give an information on how attractive the company is in the eyes of the public or potential investors. And now, we are ready for liquidity ratios. Let's expound liquidity ratios. What are these again? These are the ratios that show information about the entity's ability to settle its currently maturing obligations. So one of the formulas that is important in here is the working capital, which is just the current assets minus the current liabilities. So let's have an example. Your company has a current assets of 1.2 million and the current liability is 800,000. And since the difference is positive 400,000, we can say that the company's current assets is enough to settle the current liabilities. That is why we can conclude that the company is liquid. So if the answer is negative on the other hand, then there is a problem with the company's liquidity. Next is we have the current ratio, which is just the current assets over the current liabilities. So let's apply the same example as here, and we're going to get current assets 1.2 over current liabilities of 800,000, which will equal to 1.5. Since the answer is more than 1, then that means the current assets is bigger than current liabilities, which is good in terms of liquidity. Liquidity problem arises if the answer is less than 1. To make this simpler, this means that the current assets is 1.5 times larger than the current liabilities. Next is we also have quick assets ratio or quick ratio, or sometimes called asset test ratio, which is just quick assets over current liabilities. The question is, what is quick assets? So normally current assets is composed of cash, marketable securities, or those short-term investments that can easily be converted into cash. We also have trade receivables, and then inventories, and then prepayments like prepaid rent and supplies. You know that, right? So quick assets are just current assets, but we are going to exclude the inventories as well as the supplies and the prepayments because most of this cannot be easily converted to cash. And cash is the ones needed to settle the current liabilities. In simple terms, inventories need to be sold first. And what if it's sold on credit? Then you need to wait for the customer to pay before it's converted to cash. Supplies, also like office supplies, need to be disposed of or sold pa, which is difficult. And of course, in terms of prepayments, for example, the prepaid rent, you need to get back your advance payment from your lessor or landlord, which is not easy. Of course, the same with the current ratio. If the answer is more than 1, then the company is liquid. And then we have the cash ratio, which is using only the cash and cash equivalents divided by the current liabilities for obvious reasons, so no need to elaborate. So similar with the current ratio and quick ratio, the cash ratio, if it is more than 1, then the cash is sufficient to pay the current liabilities. And then we have turnovers. There are a lot of turnover formulas and we need to understand them one by one. We have the first turnover, the inventory turnover. But before we go to the formula, I have some tips in order for you to remember the formulas easier. So tip number 1. Since turnovers are a fraction with a numerator and denominator, on the denominator, you put whatever is in the name of the turnover. To understand what I mean, for example, this is inventory turnover, right? So you put on the denominator the average inventory. So average inventory comes from here, inventory turnover. So if you are asked what is the formula of the receivable turnover, you will know that the denominator is the average receivables. Sir, what is this average? Actually, it's just the beginning balance plus the ending balance divided by 2. And related to that is tip number 2. Whenever you are in the financial statement analysis topic and there is a formula, and that formula uses a balance sheet account like receivables, inventory, and others, you need to average them just like this one. But if it is an income statement account, no need to average because it's impossible. After all, you haven't heard of terms like sales beginning, sales ending, expense beginning, expense ending, right? So that's it for the tip. Let's go back to the inventory turnover. And we know already that the denominator is already average inventory. The only problem that we have is the numerator. So the numerator is cost of sales. You can easily remember that because beginning inventory and ending inventory is part of the computation of cost of sales. I mean, you can't really separate the cost of sales and the inventories. So enough of that. Let's have the examples. Example, you have 2 million cost of sales and average inventory of 800,000. So what are you gonna do? Of course, you're going to divide 2 million by 800,000 in order to get the answer 2.5. Sir, what's the meaning of the answer 2.5? Okay, here's the thing. When you buy inventories, it stays with you for a moment until it is sold, right? And then after it is sold, you're going to buy again. Actually, this cycle is already considered as one inventory turnover. So let me repeat that again. Inventory turnover is how many times on the average the company is buying inventory and then selling them and then buying another set again. And since the answer is positive 2.5, this means the cycle was repeated only 2.5 times within a business year on the average. Sir, which is better? Higher or lower inventory turnover? Generally, it would be better if you have a higher inventory turnover because it means your company's goods are sold faster. But it depends on the circumstances, like if your company is selling high value and very luxurious items, only few can afford, so you should not expect that the inventory turnover will be high because those items are difficult to sell. Again, is it good to have a high inventory turnover? Generally, yes. But it depends on circumstances like the nature of your business. So, let's go now to the age of inventory or inventory days, which is related to inventory turnover. This is still a fraction where the numerator is the number of operating days in a business year, which can be 360 or 365 days if ever you are operating every day. But for example, if you are closed on Saturdays and Sundays, then it will be revised. But for this example, we're going to use 360 days. And of course, we have the denominator, the inventory turnover. Let's use the 2.5 here. So we're gonna get 144 days. What is the meaning of that 144 days? It means that the inventory stays in the average in your company for 144 days before it is sold to customers. And that's it for this slide. Let's go now to liquidity ratios part 2. But first, let's answer the question, what if we're talking about inventory turnover for manufacturing entities? Of course, we know that there are 3 types of inventories in manufacturing entities, which is why we also have 3 types of turnovers. We have raw materials turnover, we have work in process turnover, and we have finished goods turnover. And of course, they have their own formulas. However, we don't have any problem with the denominators because we know that here is the average raw materials, while here is the average work in process, and here is the average finished goods. The only problem that we have are the numerators for each of these formulas. So here are the numerators. We have the raw materials used for the raw materials turnover, we have the cost of goods manufactured in the work in process turnover, and we have the cost of sales for the finished goods turnover. Maybe some of you are not yet familiar with these terms, these manufacturing terms, so I suggest that you watch one of my videos and the link is on the description below. Sir, what's the meaning of raw materials turnover, work in process turnover, and finished goods turnover? Okay guys, let's start with the raw materials turnover. Of course, you will buy some raw materials, and then you are to store it in a warehouse for quite some time, and then you will use it in the manufacturing process, and then you will purchase again raw materials. So the number of times that cycle repeat in a business year is the raw materials turnover. Of course, In the work in process turnover, it will be in process for quite some time until it will be completed. And then you will process again another set of work in process inventory. So how many times it happens is the work in process turnover. And lastly, we have the finished goods from being unsold. It will then be sold. And of course, after those are sold, another set of finished goods, the unsold ones, will wait until it will be sold. The number of times it happens is the finished goods inventory turnover. Sir, how about the age of inventories? Will the computation change? No, it is still the same. The numerator is still the number of operating days in a business year over the inventory turnover. But if you wanted to be specific, if you're looking for raw materials inventory days or work in process inventory days or finished goods days, then you can substitute this with the raw materials turnover or work in process turnover or finished goods turnover. So for example, if you have 5 days, raw material days, work in process days, and finished goods days, that means it takes 15 days to sell your product to your customers. Or if you want it to be simple, from the buying of raw materials and then converting it and then selling it to the customers, it takes 15 days to do all of that. That's it for the inventory turnovers and age of inventories. Guys, we also have receivables turnover. So let's go to the formula. Of course, the denominator is the average receivables. But what about the numerator? So answer this question first. What transaction leads to recording of accounts receivable? We all know that it is credit sales, right? So actually, that is the numerator. The question is, what is the receivable turnover? It is the cycle where first the customers incur debt from you because they purchased something on account and they will eventually pay, and then go back to incurring debt again. So receivable turnover is how many times this cycle happened. Age of receivables is similar with the computation of the age of inventories, which is the number of operating days in a year divided by the turnover. But in this case, we're going to use the receivable turnover. And for example, we got 10 days as the age of receivable. What does that mean? It means to say that your customers usually pay their debt every 10 days on the average from the time they incurred the debt. We also have the payables turnover, which is the denominator is of course the average payables, and the numerator is credit purchases because credit purchases is the reason why we record the accounts payable. The payables turnover is simply how many times the entity incurred debt and then pay and then incurred debt again. And the age of payables is number of operating days in a business year over the payables turnover. So that's it for turnovers. But still, related to the turnover, we have the operating cycle, which is just the sum of the inventory days and the receivable days. Example, the age of inventory is 5 days and the receivable days is also 5 days. Before we get the answer, let's analyze deeper. The inventory days is the number of days where you buy the raw materials and then sell them. And in order to understand the operating cycle, let's assume that you have sold the inventories on account. So the receivable days is 5 days. So you need to wait for additional 5 days in order for you to collect. So it's as if the operating cycle is the number of days needed so that you can get a cash inflow from customers. And if you get that information, you can decide on a lot of things. Like for example, you can incur debt even if the maturity of the debt is 15 days because you know you will have cash from customers after 10 days. So that's it for the operating cycle. Lastly, we have the conversion period or cash conversion cycle, which is the operating cycle minus the payable days or the age of payables. For example, you have an operating cycle of 10 days. So that means you can collect every 10 days on the average from your customers, and your payables or age of payables is only 1 day. That means you are paying your debt every day. So your inflows and outflows are mismatched by 9 days, which is bad because if that happens, in order to keep on paying every day, you will need to borrow funds from banks and other sources, and that will cost you interest. That is why lower conversion period is generally better. So what will you do to minimize conversion period? So you have a lot of options. Number one, you can meet with the suppliers and tell them to extend their credit terms. Or you can also decrease the operating cycle by decreasing inventory and receivable days. But how? You can be strict with your customers and revise your credit terms so that they will pay faster. And you can make your inventories manufactured faster and sell faster by means of, for example, re-engineering your manufacturing process to make it more efficient. And there are a lot of methods. Before we end this video, I would like to test if ever you remembered still the tips. For example, you're going to be asked, what is the formula for assets turnover? Of course, the denominator is average assets. It's okay if you don't know the numerator. So, I will give you the numerator. It's the total sales. And before we end this, let's have a little bit of summary, or you need to have these things that you need to remember and understand, which are: number one, horizontal analysis is simply comparing the account balances of different time periods, and it can also be a comparison of your company's numbers with industry averages. So the vertical analysis, on the other hand, is comparing an account balance with the balance of an assets or total revenues. And of course, the company is liquid if, number one, the working capital balance is positive, and number two, the current, the quick assets ratio, and the cash ratios are more than 1. Aside from that, it would be better if, number 1 and 2, the average turnover is high, the average age of inventory is low, because this means that your inventories are sold faster. And of course, it's better if the accounts receivable turnover is high and the age of receivables is low, because that means your customers are also paying faster. It's the opposite for the payables turnover and the age of the payables, because you wanted to pay as low as possible unless there are discounts or penalties involved if you pay longer than the supplier allowed. So if that happens, you need to compute the benefit versus the cost. Sometimes it is better to pay faster or to pay earlier if there are large discounts or penalties involved. And of course, we want to have an operating cycle which is low, because that means the cash inflow from customers are faster, and of course, we need to have a conversion period that is low. So that's it for this video lecture. In the next episodes, we will focus on market ratios, profitability ratios, and solvency ratios. And of course, the trademark of my video lectures are the comprehensive problem, of course, with solutions.